capital gains on rental property. I just took you through the basic process on how to work out your capital gain or loss. Now, this extra step is targeted at small businesses and is what we call a small business concessions that you are available to you in terms of working out your capital gains tax. Now, the ATO has on their list or their prescribed criteria for the small business concessions is that your turnover has to be below $2 million per year. So if you're a small business and your turnover is below that amount, there are certain concessions available to you in order to save you more and more of your capital gains. Now, again, I need to let you know that this is purely a tutorial video. It's educational and it's not a substitute for any type of financial advice. If you do need advice tailored to your own individual circumstances, I do work in an accounting practice and I do come across these situations almost on a daily basis. So feel free to contact me and we'll work out a suitable time for an appointment. So let's say you bought a capital gains asset purchased. Now, it may be a property or it may be something else, but this asset is used in your business. So let's say, for example, you run a business and your business owns the building in which it operates. You will have some concessions available to you depending on the fact that your turnover of your business remains below $2 million as part of the concession rules. Let's say you purchased this business and the building in which your business operates. Let's say purchased in 2006 and cost, let's say it was $1 million. Okay, now with that, there's obviously extra stamp duty and other purchase costs ranging to, let's say, around about $120,000. So your total cost is $1,120,000. Now, let's say, for example, you sell the business or sell the building in 2020. So that's 14 years from when you purchased it in 2006 through to 2020. Let's say the sale price of that is $2,500,000. Okay, now we need to also add sale costs, which is commission on sales and settlement costs and so on. They can amount to around about $50,000. So these sale costs are part of the cost base. So the total cost base of the property is $1 million, your purchase price, plus $120,000, the stamp duty and other settlement costs on purchase, plus your $50,000, which is comprised of commissions on sale and other costs on settlement of the sale. So you now have a total cost base of, we'll make the number easy for you to read, $1,170,000. Sale price, it remains the same at $2,500,000. Now, in simple terms, the capital gain on this is your sale price minus the cost base, which is $1,330,000. Now, assuming your business is in a trust structure, that is eligible for a 50% discount. So discount 50%, or assuming that you that you have the business in your individual name, even you still qualify for a 50% discount. But please bear in mind that if you are running this business under the name of a company, and that the company owns the building or the premises in which your business operates, then the 50% discount is not available for the company. So take 50% of 1.33 million. So equals this times 50%. You're left with a gain of $665,000. Now, one of the CGT concessions is that you can also apply an active asset reduction, and you can apply another 50% of that. So let's just maximize this. So you can apply another 50% of the $665,000. That brings your net gain now down to $332,500. And that's the assessable gain. So the net gain is equal 665 minus 332. So you've been able to use the 50% discount and you on the 1.3 million, and you've also been able to use another 50% as an active asset reduction. So your business will now be assessed on a capital gain amount of $332,500. Now, assuming you have a trust, you can distribute that net gain onto individual beneficiaries or company beneficiaries, or whichever beneficiaries you prefer, provided that your trust is what we call a discretionary trust. It has the discretion to provide, to distribute any of the income to any beneficiaries with a tax file number. And that way, you will save some tax on that too, having received a portion of that from the trust. Now, this is on the basis that you sell the business or the building after 14 years, because we said that it was purchased in 2006 and you sold it in 2020. Now, suppose you sell the asset. Sale date, you sold it on 31st October 2021. Now, at that point, you would have had your business for a total of 15 years. Now, let's use the same sale price. Sale price, 2,500,000, and cost base is 1,170,000. So we haven't changed the cost base and we haven't changed the sale price. So you're left with a gain of the same amount, basically $1,330,000. Now, one of the concessions available to you as part of the small business capital gains concession is, now that you've had this business or the asset for at least 15 years and you're close to retirement, this whole gain is exempt. Exempt gain under 15-year concession. Now, what that enables you to do is to declare the capital gain. We still have to put it in the tax return that it is a capital gain, but you have one of those small business concessions that you can put in, and your accountant and tax agent will know how to do that in your tax return. You just apply the 15-year concession, and that way you will not be taxed on any amount of the capital gain. So that's another concession that's available to you. The other concession available to you on a capital gain is what we call a superannuation rollover. So if you are under 55 and you have a capital gain from selling your asset, you can roll over up to a limit of the proceeds from the sale of your business, or a limit of the gain into superannuation. I think from memory the limit is $500,000, but please check that with your accountant and tax agent. So that limit is a lifetime limit. If you roll that over into super, any excess of that is taxable to you. So you can see the difference between if you sell your business or sell your asset after 14 years, you're going to be taxed on $332,500, or that will be your net income from the sale of your asset or business or building, in which you will then need to distribute to beneficiaries. Whereas if you had the business for at least 15 years, you can claim this 15-year exemption. Any gain is not taxable in that. Now, again, from the previous capital gains tutorial, if you have a self-managed superannuation fund, SMSF, this net capital gain will only be taxed at 10%. So 10% of 332,500 is $33,250. That's a tax liability that will be payable in your super fund. If you had that building, if you had it as business real property in your SMSF. So these are just different ways in saving tax if you qualify for the small business entity concessions, and in relation to any capital gains from the sale of your asset or your business.